Hey, welcome back to Everyday Economics. This is the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, publisher of the Center Square. Everyday Economics is brought to you by the Center Square. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on January 31st, 2025. And joining me, as always, my friend and colleague, the great one, Dr. O. Orphe Divounguy, PhD economist. Dr. O, there was a lot of anticipation last week as the Federal Reserve was sort of stewing and brewing over what to do with the federal funds rate. Of course, we had President Trump was installed just on I believe it was the 20th of January, so maybe less than 2 weeks ago, 10, 11 days ago, and there was potentially some pressure there on Fed Chairman Jerome Powell to do a little something, maybe of the president's liking. He's calling for lower interest rates, and there was some drama around it, but we got what we thought we were going to get, which was no change. You want to talk about it? Tell me what did or didn't happen there.
Well, there's no change. The Treasury yields actually eased a little bit. The markets expected no change. But I think this statement, and again, maybe Chair Powell sounded a bit dovish in his press conference, but I think the actual statement, FOMC issued statement, tells the whole story. And what do I mean by that? Well, first, they maintained the rate at 4.25% to 4.5%, pausing. And the big question is, how long will they be pausing for? Will we actually get rate cuts later this year at the March meeting or even the June meeting? The June is where I think the markets were anticipating rate cuts in starting in June. And still does. And I looked at the statement, right? It starts with this labor market assessment. How's the labor market doing? Well, in the December statement, and I'll read verbatim, the labor market conditions have generally eased and the unemployment rate has moved up but remains low. That was changed to the unemployment rate has stabilized at a low in recent months. And the labor market conditions remain solid, right? Again, this signals a shift from concern about a softening labor market to a more confident stance.
Hold on, you didn't read the next sentence, and so I want to get your take on the next sentence in there, which is inflation remains somewhat elevated, because don't forget we talked within the last couple of weeks of are we headed toward 3% annual inflation being normative? And so what do you make of the fact that inflation remains somewhat elevated?
Exactly. We went
as part of that.
Yeah. We went from inflation has made progress towards the committee's 2% objective, will remain somewhat elevated, to inflation remains somewhat elevated. They moved away from progress on inflation.
Are they softening us up for but seriously, are they softening us up for a new normal?
They're admitting the fact that inflation progress may have stalled, and that their concern is that disinflation has slowed, and that we're not seeing progress. And I think, again, the statement to me is very hawkish. Last part. Maybe not quite the last part, but let's look at economic activity in the statement. Economic activity has continued to expand at a solid pace. It has not changed, right? This is unchanged from previous, right? So we got strong economic growth. We have a labor market that's no longer softening. Remember, the Fed rate cuts came after the softening labor market, the fear that the labor market was cracking end of last summer. That is no longer the case. At the same time, inflation is no longer making progress towards 2% inflation. What does that tell me? What are the implications? Well, the implications is sticky inflation, strong economic growth means no more rate cuts.
Right.
That is what that means. And so I think it's important to kind of be prepared for the Fed to stay on hold for a long while. I wrote about it, of course, in the Center Square column this past week. I said, look, if the neutral rate is rising and the real funds rate is falling, remember the distance, the gap between the real rate and the neutral rate, it tells us whether policy is restrictive enough. So if the real rate is greater than the neutral rate, then policy is restrictive, right? Current interest rates are too restrictive for the economy, and could cause the economy to slow down. If it's the opposite, then policy is loose, and so the economy could actually expand as a result. And so the idea is that maybe with inflation expectations rising, inflation stubborn, maybe interest rate policy is not as restrictive as we thought it was. Uh, as long as, and by the way, we don't know what this neutral rate is. It's kind of it's a theoretical concept, right?
Right, that's extremely vague for I think for the expert and for people that are just trying to make sense of what's
Yes,
going on. I mean that
we
sounds
don't
like politispeak to me.
we don't know what it is. We just know that in an economy, this neutral rate is the rate that makes policy neither restrictive uh, nor not nor stimulative. And so it's a big unknown, but the Fed is trying to figure out what it is by basically just looking at how its policy changes affect the economy. And right now, right, we had a couple rate cuts in 2024, and we went from easing inflation and cooling economic growth to stronger economic growth, more resilient, maybe. No
Right.
longer a labor market that's no longer cooling, that it seems to have stabilized, and inflation potentially moving slightly higher, right? And so,
Well, let's talk about that because the personal consumption expenditure PCE numbers came in. We're taping this on Friday the 31st, and the PCE index rose 0.3%, and it's up 2.6% from a year, like from the previous year, right? And so things are costing us more. Um, so factor that into your thinking. Make sense of that, please.
yeah, well, I mean, we get a PCE, the latest PCE data that shows inflation has moved. Headline inflation actually accelerated,
Mm-hmm.
and so that's a problem. That's a problem for the Fed. But the good news is that core inflation has basically remained somewhat flat, right? So that is another one of those. Hey, are we seeing disinflation? We were hoping to see more core disinflation. We're not. It's been pretty flat, and now we're seeing headline PCE uh, kind of rising, right?
Yep.
On a month over month basis. Uh, Now, at the same time, uh, we had the employment cost index report that shows the employment cost index rose by 0.9% quarter on quarter, and slightly, as expected, but slightly higher than the previous reading of 0.8%, right? So you have an economy that may not see a big reacceleration in inflation,
Huh?
but that is not showing a big improvement in terms of disinflation either. We are somewhat stuck. And again, in a previous column, we talked about the possibility, and you brought this up, the possibility that the Fed has conceded that inflation may be stuck around the current level. Uh,
Well,
and
yeah. I mean, if you can't get the number to the number that that you've always been able to get it to, then what, you start lobbying for maybe a new number, and the way that would occur would be kind of like what we're seeing. Like, oh, this might be the new normal. That 3% inflation might be the way of the world from here on out. I don't know. I'm a little uncertain as to how to
Well,
process it.
well, for Fed credibility, I don't think we'll ever hear that the target has changed.
I don't either. I mean, and that's sort of why I raised the flag right here, because I mean, I don't know that we're ready to throw out the what has always been for the what is right now, and I mean, and that seems to be the scenario that we're in.
The target hasn't changed, but it's clear to me that we're likely not going to get another rate cut for a while.
And I think that that's really what this is all about. And I think that that's a good place to bring us to an end. This is a conversation that you and I are going to have, I think, multiple times over the course of the year. And I think it's something that, of this year in particular, and it's something that we're gonna have to spend some time with, because I think it really is kind of where the puck is headed. So we'll call it good, and we'll come back. We have one more episode. We're going to talk about AI coming up on the next show. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics wherever you get your podcasts, and listen to Orphe and me every week on the Center Square Radio Hour.